Let's now look at the percentage of completion method. Now, the percentage of completion method, as indicated earlier, recognizes revenue by the proportion of costs incurred to the total costs of, for example, a long-term construction contract. So let's look at Bardeen Company, which at the beginning of 2011 received a contract to build an office for $5 million. Now, the project is estimated to take 2 years to complete, and it will cost $3,750,000. We are provided with costs incurred in 2011 and 2012, respectively, as $1.5 million and $2,250,000. Now, what this means is that the contract yields an expected gross profit of $1,250,000 over the 2-year period. Now, how did I get $1,250,000? I subtracted the total cost, that is $3,750,000, from the total revenues, which is the contract price, $5 million. So subtracting that gives $1,250,000, which is the expected gross profit. Now let's look at the revenue recognition. Recall that under the percentage of completion method, we can recognize revenues each year during the 2-year period for this project. So for 2011, we will recognize revenues based on the proportion of cost incurred in 2011 compared to the total cost. So we first start off with the percentage of the contract completed as at end of 2011. And that is determined by dividing 1.5 million and 3,750,000, and we get 40%. So we estimate 40% completion. So we recognize 40% of the total revenues, 5 million. So 40% of 5 million is 2 million. So we can recognize 2 million revenues in 2011. Now for 2012, we see that 2,250,000 was the cost incurred. So the percentage of work done in 2012 is 2,250,000 divided by the total cost of the project, 3,750,000. So when we divide, we get 60%, and 60% of total revenues is 3 million. Let's now discuss some of the risks of revenue recognition. We first look at the percentage of completion method and the risks associated with revenue recognition under this method. Now, based on the long-term construction contract example we just reviewed, a company could overstate revenues, inflate revenues up, if it uses a lower estimated total cost of the project in a period. This is because a lower total cost implies a smaller number in the denominator, which will be used in the calculation of the percentage of completion. Now, using a smaller denominator increases the percentage of completion, which in turn will yield higher revenues. Note that a similar risk may apply to service outsourcing and rental contracts as revenue may be recognized for such contracts using the percentage of completion method. Let's now look at gross versus net sales, or gross versus net revenues. What are the risks associated with that? Now, the risk is that companies may record commission sales at the gross amount rather than the net commission that represents the true earnings for the agent when the agent sells the inventory. Now, grossing up the sales would obviously inflate profits reported for that agent company or dealer company. Let's now turn our attention to sales on consignment. In sales on consignment, a company earns revenue as an agent for the seller. It does not take title or ownership of the inventory, and as a result, it cannot characterize the gross revenues or sales as its sales. What it rather should do is disclose the consignment arrangement and identify its revenues as commissions rather than sales. Thus, one potential problem could arise if the company records these commissions before the sale is actually made to the final buyer. Let's also discuss risks related to multiple element sales contracts. Now, a multiple element sales contract is a sales agreement that bundles goods and services that may or may not be delivered simultaneously. Let's consider an example. Let's say Amazon considers the Kindle as a multiple element contract because the hardware is a separate deliverable from the wireless access and the promise of future upgrades to the operating system. Now, because a multiple element contract involves deliverables which are separate, what Amazon should do in such a situation is recognize revenues on each element at the time revenue is earned for that element. However, what we tend to see is that in some cases, companies recognize all the revenues up front for all the elements of the contract. Non-refundable fees. Now, that could also pose some risks. Now, when a company collects non-refundable fees for future goods to be delivered or services to be performed in the future, it is important to emphasize that revenues have not been earned. Until the company earns the revenue, the amount received is actually a liability, as it represents a future performance obligation for the company. If the company expects to earn the revenue in the coming year, the amount received is a current liability. Otherwise, it is a long-term liability. Let's consider some examples. Customer deposits. Now, this is a collection upfront for goods or services to be provided by the company in the future. Another example, gift cards, season tickets. non-refundable membership fees paid upfront, layaway plans of retailers. Let's now consider the last item, which is sales with right of return. Now, we know that many companies offer the right of return with sales. Now, companies that offer a right of return with sales can only recognize sales if the estimated returns can be determined. Now, estimating the returns will be matching the cost associated with the sales, and this time it's a contra account, but it's a cost. You can consider that as a cost. That is, items that will be returned should be subtracted from the total sales. So companies that offer a right of return with sales can only recognize sales if the estimated returns can be determined. Again, note that the estimated returns will be a reduction of the gross sales. Now, if a company cannot estimate the returns, then it must delay revenue recognition until the end of the returns period. Now, this ends our discussion of the income statement.